The models, they do not lie. Machines found a signal buried inside 40 trillion data points. 40 trillion data points. The last crash cost $22 trillion. This time, the data, it is screaming. Global supply chains are fracturing. The models have already picked a window. Consumer spending is collapsing in silence. The data knows who is lying. Consumer spending is collapsing in silence. The crash window is open. Rapid cut global stock exchanges turning red in sequence like dominoes. The countdown, it has already begun. The models don't lie. For the first time in history, machines saw it coming. A signal buried inside 40 trillion data points. And what they found should terrify every person on this planet. The last crash cost the world $22 trillion. This one, the algorithms warn, could be 3 times worse. We had warnings before. We ignored them. This time, the data is screaming. Supply chains are fracturing. Debt is hitting levels never seen in recorded history. The central banks are out of ammunition. And the models have already picked a window. Consumer spending is collapsing in silence. The malls are empty. The orders have stopped. But official reports still show growth. Someone is lying. And the data knows who. This is not a prediction, this is a calculation, made by systems that processed what humans refuse to see. The crash window is open, and the countdown has already begun. Data science was born to find patterns humans miss. In economics, those patterns repeat. The shapes are different each time, but the ending is always the same. Global debt has crossed $315 trillion. That number was unthinkable a decade ago. Every model trained on historical collapses flags this. There is no soft landing at these altitudes. The institutions are silent, but the metrics are not. Unemployment indicators, credit spreads, yield curves, all pointing the same direction. Contagion doesn't announce itself. It moves through systems quietly, until it can't. When you finally see it, the window to act has already closed. Food prices, energy prices, housing costs, each one a crisis alone. Together, they become something else entirely. They become the kindling. Real estate was the accelerant in 2008. Today, the numbers are worse. Mortgage delinquencies climbing. Construction halted in 14 major markets. The International Monetary Fund has issued 3 warnings, each one dismissed as politically inconvenient. But the models don't run for office, they only calculate truth. Algorithms now execute 70% of all market trades. When they sense danger, they don't hesitate. They exit simultaneously, and no human intervention can stop it. The real economy feels what the markets deny. People losing jobs faster than headlines admit, savings evaporating, pensions at risk. The gap between data and reality is closing fast. There are 2 versions of the economy, the one you're told about and the one the data shows. They have never been further apart. The models reached 87% confidence last quarter. By most standards, that's certainty. Preparation has already begun for those with access. The public remains uninformed. China's debt crisis is the invisible wildfire, $50 trillion in obligations, mostly hidden. When it surfaces, the shockwave won't respect borders. No economy will be untouched. Europe is fighting on multiple fronts: energy dependency, banking fragility, political fracture. The ECB models show the same pattern as 2009, but amplified by a factor of 4. Energy is the artery of every economy. Constrict it, and everything downstream suffers. The models track energy volatility as a leading indicator. Right now, it is flashing the brightest warning yet. Capital flight has already begun, quietly, strategically, without announcement. Those with the most to lose are moving fastest, leaving the question, who gets left behind? Food insecurity and economic collapse are historically linked. In every major crash, food costs rose first. The correlation in current data is 94%. The models have seen this sequence before. In 2008, bank runs were digital, silent, invisible. The next one won't be. Social media will accelerate the panic in hours, not weeks. The models factor this in. The speed changes everything. Governments are printing, and borrowing, and printing again. Every debt ceiling raised becomes the new floor. The models call this a doom loop. History calls it the last chapter. Japan's yield curve control policy is breaking down, a strategy that worked for 30 years, failing now. When Japan sneezes, global bond markets catch pneumonia. The models have flagged this since late 2023. The personal savings rate has gone negative. Americans are borrowing to live, not to invest, not to grow, to survive. When economies fail, streets fill. History is unambiguous on this point. The data predicts the economic crisis. Social unrest follows within 18 months. Governments have contingency plans for economic collapse. They've had them since 2009. The question isn't whether they exist, it's whether they've already activated them. The model was back-tested against every major crash of the past century. It called each one correctly within 6 months. Applied to today's data, it names a window between mid-2025 and the close of 2026. The smart money is already positioned, billions in short positions, billions in gold and bunkers. They read the same data, they just don't share it with you. Every bubble in history had a moment when the insiders knew, when the math was undeniable. We are living in that moment right now. Credit default swaps were the canary in 2008. They're singing again, louder this time, and nobody on television is talking about it. Assets are moving underground, digital and physical, fast and silent. The architecture of the next crash is being built in plain sight, brick by invisible brick. When governments can't sell their bonds, the game changes. Historically, this is the event that accelerates everything. 3 nations are approaching this threshold. The models call it the tripwire, 89%. That is not a fringe estimate. That is a consensus of the most advanced economic models ever built, and it lands in your lifetime. Part 1 ends here, but the story doesn't. The signal has been read. Now comes the question, what will you do with it? Every collapse has a structure, a skeleton built years before the body falls. Data science has learned to read that skeleton, and what it reads in today's data is unmistakable. In 1929, the warning signs were there. Overextended credit, asset bubbles, speculative mania. Today's data science tools would have called it 6 months early. We have those tools now. The question is, who is listening? The housing market was the match in 2008. This time, the fuel is everywhere. Corporate debt, student debt, sovereign debt. The match doesn't matter when everything is gasoline. Contagion models trace how failure travels. Bank A fails, Bank B is exposed. Bank C follows. In 2008, it took weeks. In the next crash, machine speed compresses that to days. Currency collapses are the cruelest kind of crisis. They happen overnight, savings wiped, purchasing power gone. The data shows 6 currencies currently in pre-collapse configuration. Debt to GDP ratio is the model's most powerful predictor. The United States is at 130%, Japan at 260%, Italy at 145%. Historical precedent above 100%, no peaceful exits. Interest rate hikes were the weapon against inflation, but at these levels, they become the weapon against the economy itself. Mortgages that can't be serviced, businesses that can't refinance, the cure becoming the illness. Every recession since 1973 was preceded by an energy shock. The models include this variable. Current energy price volatility scores at 94th percentile. The pattern is not broken, it is repeating. Emerging markets are the first to feel global tightening. Their reserves thin, their currencies collapse, their populations suffer. This is the first stage of global contagion. It has already begun in 11 countries. Corporate America is in a silent contraction. Layoffs dressed as restructuring. Revenue declines reframed as right-sizing. The language is polite. The data is brutal. Smart capital moves before the crowd. The data tracks offshore flows, gold purchases, real estate in safe havens. All of these indicators are spiking simultaneously. The wealthy have already voted with their wallets. Central banks are the last line of defense. In 2020, they deployed $9 trillion in emergency measures. That ammunition is spent. When the next crisis hits, the toolkit is empty. The real economy is what feeds people. Financial systems are the scaffolding around it. When the scaffolding collapses, the real economy is buried. And recovery takes not months, but decades. In 1929, global GDP fell 15% in 4 years. Unemployment reached 25% in the United States. The models don't predict this exact outcome, but they don't rule it out either. Perception lags reality in every financial crisis. The official story holds until it can't. That gap between what the data shows and what is broadcast is where fortunes are made and lost. The tech bubble was the alarm in 2000. Today, AI valuations echo that math. Companies with no revenue, valuations in the billions. The models have a word for this: irrational exuberance. The petrodollar system has been the foundation of dollar dominance. For 50 years, oil was priced in dollars, no exceptions. That agreement is now fracturing, and dollar hegemony may not survive the fracture. A parallel financial system is being built in real time. Dollar alternatives, gold-backed trades, settlement systems outside SWIFT. When this reaches critical mass, the US economic model faces its greatest test. One island produces the chips the world runs on. Every car, every phone, every weapon system, every server. The economic model includes geopolitical risk, and Taiwan risk is scoring at levels not seen since 1996. Climate risk is now embedded in every economic model: physical damage, stranded assets, migration costs. The crash the data predicts may be accelerated by a climate event. The two timelines are converging. When insurers stop insuring, the signal is unmistakable. Whole regions becoming uninsurable, homeowners stranded, businesses unable to operate. This is the quiet collapse before the loud one. War and economic collapse are historically linked. Governments under fiscal pressure make geopolitical mistakes. The defense spending spike the models detect isn't just military, it's an economic distress signal. Denial is always the last act before the fall. Every collapse in history was temporary until it wasn't. The models don't read press releases, they read capital flows, and the flows are running for the exits. The Baltic Dry Index doesn't lie. It measures actual physical goods moving across actual oceans. No spin, no narrative, just freight. And right now, freight is saying the world is slowing down. The legislation for the next crisis is already drafted. Capital controls, bank bail-ins, emergency economic powers. Regulators plan for what they don't announce publicly. The existence of the plan is itself the signal. Economic crises create political crises. Extreme conditions produce extreme politics. In every depression in recorded history, governance degraded. The models include political instability as an output variable. Continuity of government includes continuity of economy. These plans exist. They have been updated recently. The models flag increased preparation activity as a leading indicator. Preparation is itself a prediction. Central banks bought more gold in 2023 than any year since 1967. They're not buying for aesthetic reasons. They're buying because they no longer trust the system they built. When the builder doesn't trust the building, leave. A cyber attack on financial infrastructure is not theoretical. It has been simulated. It has been attempted. The models include cyber-triggered systemic collapse as a trigger scenario, probability assessed at 23% within the crash window. The convergence of signals is what makes this moment different. Not one indicator, not two, dozens simultaneously. The models have never seen this configuration outside of historical collapses, and they have seen every collapse. Too big to fail was a phrase invented after 2008. Today, the two big institutions are bigger, their interconnections are deeper, and the safety net that caught them last time has been consumed. Crypto was supposed to be the alternative. Instead, it became another layer of systemic risk. $2 trillion in digital assets linked to the traditional system in ways poorly understood. A new contagion vector barely mapped. The analysts who built the model have a message: not panic, preparation, but preparation requires acknowledging the threat. And that is where the system keeps failing. The data is not about abstractions. It is about this family, this mortgage, this job. Behind every percentage point in the models is a person, and the models say those people are running out of runway. Part 2 showed you the architecture, the skeleton of collapse built in silence. Part 3 will show you when it starts to shake. The tremors have already begun. The tremors are not future events. They are happening now. The markets are beginning to behave like they did in the months before 2008, except this time the amplifiers are larger. The first bank doesn't announce it is in trouble. It simply begins to slow. Transactions delayed, withdrawals limited, phone lines busy. The digital run starts before the cameras arrive. Currency instability spreads confidence instability. When people stop trusting money, they stop trusting everything. The psychology of collapse is faster than the economics, and social media ensures it moves at the speed of light. Small businesses are the economic immune system. When credit tightens, they are the first to go, and their closure creates a hole in the economy that chains produce cannot fill. 47% of American employment gone, quietly, first. When bond markets break, everything follows. The bond market is larger than equity markets. When it moves against governments, governments lose. The yield spike is the first tremor that precedes the quake. Sovereign defaults are contagion vectors. They freeze credit markets for neighboring nations. They trigger investor panic in asset classes globally. The first default in this cycle has already occurred. Economic collapse does not stay in the markets. It walks through the hospital doors within 18 months. Healthcare rationing, social service cuts, infrastructure deferred. The human body count of a financial collapse is always hidden. $1.7 trillion in student debt in the United States alone. Default rates climbing for the third straight year. A generation priced out of home ownership before the crash. The model sees this as both symptom and accelerant. Pension funds are the sleeping giant of the crash. Trillions in obligations, investments built for a world that no longer exists. When the market drops 40%, their mathematics breaks, and the people who trusted the promise find it was never funded. Governments plan for what they can't say publicly. The economics of social control in crisis conditions. History is unambiguous. Extreme economic stress leads to extreme responses. The data models end at the economics. What follows is history. Wars are expensive and economically destabilizing. Active conflicts in the current window are more numerous than any period since 1945. The models treat geopolitical risk as an exogenous shock variable, currently scoring at maximum observed historical levels. Supply chains are the capillaries of the global economy. When they clog, the body shows the symptoms immediately. The data tracks 14 separate supply chain stress indicators. 12 are currently in the red zone. The energy transition is necessary, but the economic models of the transition are built on assumptions now collapsing. Green investment requires stable credit, stable currencies, stable growth. The conditions for transition are being destroyed by the conditions requiring transition. Circuit breakers were invented to slow the cascade. They cannot stop it. They are the speed bump on the road to the cliff. In 2008, they were triggered 4 times in a single week. The models deal in percentages and probability distributions. Behind each percentage point, a family. Behind each probability, a life. The data predicts the math. History records the human cost. Flash crashes are no longer anomalies. They are rehearsals. Each one tests the system's ability to self-stabilize. The last 3 were successively worse. The models note the trend. Emergency rate cuts are a white flag. The central bank announces it sees what it denied seeing. Markets rally briefly. Then, reality reasserts. The sugar high of policy action has a duration. The model knows it. When the media turns its full attention, it is already late. Every major crash in history was obvious in hindsight. The data knew. The media was last. This time, the models published their findings. Nobody broadcast them. Economic collapse exports its population. The people move toward stability. The stability they move toward absorbs the pressure or fractures under it. The models track migration as an economic stress indicator. It is spiking. Consumer confidence is the economy's pulse. When people stop spending, businesses stop growing. When businesses stop growing, people stop working. The spiral has its own momentum once it begins. When corporate earnings disappoint at scale, stock prices do not wait for explanations. The algorithms sell before the analyst finishes speaking. Speed without wisdom, power without accountability. When governments cut spending to survive their debt, they cut growth at the same time. Austerity is the treatment that makes the patient weaker. The models have data on this. The results are not encouraging. The human cost lives inside the institution too. The analysts who see it first carry it first. The model runners who know the output but cheat but cannot change the input. Hyperinflation is the end state of monetary dysfunction. Venezuela, Zimbabwe, Weimar Germany. The models assign a 12% probability to hyperinflationary conditions in at least one G20 economy. 12% is not negligible. 12% changes everything. When the system reaches a threshold, the principal actors meet, not on record, not in public, decisions of enormous consequence made in complete informational darkness. The models predict the economic outcome. The meetings determine whether it's managed. The dollar is not just a currency. It is the infrastructure of global trade. When its credibility erodes, the cost of everything denominated in it rises. And right now, the infrastructure is under stress at every load-bearing point. Manufacturing is the backbone the financial sector forgot it had. When factories close, the recovery takes years. Financial markets can recover in months. The real economy cannot be printed back into existence. Political instability and economic collapse amplify each other. The feedback loop is well documented. It is also well underway. The models don't predict which government falls. They predict that some will. Economic security is national security. The intelligence community has its own economists. Their models run the same data, but without the political constraints. The conclusions are not classified. They're just never published. The public responds before the government admits. Information moves faster than policy. People preparing quietly, not from paranoia, but from data. The same data that the models run. Available to everyone. Ignored by most. Printing money is not a solution, it is a postponement. Every postponement accumulates interest. The bill for the last decade of monetary experiments is now due. When the experts see the same result from different models, consensus forms in silence before words. Nobody wants to say it first, but the numbers don't require anyone to say anything. The story you're watching is not on mainstream financial television. The models are not featured in primetime broadcasts. The gap between data reality and media narrative is the space where preparation becomes impossible. The macro and the micro are the same story. The models run at the national level, but the crisis lands at the kitchen table. Part 4 will show you what happens next. The tremors build toward the quake. The data does not offer comfort, but it offers something more valuable. Warning, time, and the choice to act. Every collapse in history was also a beginning. The Great Depression built the regulatory architecture that followed. 2008 birthed fintech, crypto, and a new generation of skeptics. The question is not whether we survive, it is what we build after. Governments respond, they always do. Every crisis forces an institutional pivot. The question is, too little or too late? The models suggest the response window is shorter than institutions typically operate. Speed is the variable governments are historically worst at. Crisis accelerates innovation. It forces a complete rethink of our established systems. Every financial collapse in history produced new systems. The Depression gave us deposit insurance. This collapse, the models suggest, may give us something far more fundamental. Communities are more resilient than institutions. They adapt faster. They respond to actual needs. Every crash reveals that the local economy is more fundamental than the global one. The models don't capture this. It is the data's blind spot. Economies do not die, they transform. The jobs that disappeared in 2008 did not all return. New ones appeared, often better. Crisis is also restructuring. The district begins to breathe again under a new normal. Every crash rewrites the rules. 1929 gave us the New Deal. 2008 gave us Dodd-Frank. The next crash will produce a framework we cannot yet name, but can predict must come. Globalization is being selectively reversed, not entirely, but strategically. The efficiency of global supply chains was never free. The hidden cost was vulnerability. The crash revealed the invoice. Every crisis becomes curriculum. The models are rewritten with the blood of experience. The economists who understand this one will shape the next 50 years. Data science will be at the center of that understanding. The signal in the noise will finally be taken seriously. Reform follows reckoning. The central architecture undergoes a fundamental shift. Not always, not fast enough, not always sufficient. But the window when change is possible is the window that opens in crisis. The models predict the crash. History predicts the reform. Food security is economic security. The models that predicted the crash also predict the policy response. Nations that emerged strongest from previous collapses maintained food sovereignty. This lesson is being relearned the hard way. Crashes redraw the map. Geopolitics follows the flow of the new economic tide. Not just of economies, but of power. The nation that manages its crash best leads the recovery. The data suggests this transition is already underway. The economy that emerges from a crash is always different from the one that entered. Not always better, but different. The data science that predicted the crash can help design the system that replaces it. The recovery cannot rebuild what failed. It must build what should have existed. The models that predicted the crash also model the recovery paths. The green path is not the comfortable one. It is the only viable one. Central bank digital currencies were theoretical before the crash. After it, they are policy. The financial system that emerges will be more public, more accessible, more monitored. Whether that is liberation or control depends on who you ask. The models measure GDP. They cannot measure the strength of community. The neighborhoods that survived best were not the wealthiest. They were the most connected. Resilience is relational. The data science doesn't capture this yet. GDP measured the problem and missed the point. The crash forced economists to ask a harder question. What is an economy for? The data science of the future will be built around the answer. The cities that rebuilt most successfully shared a characteristic. They distributed the decision-making along with the resources. The crash revealed the brittleness of centralized economic control. The response was to distribute the architecture. The next early warning system will be better, because this one worked and nobody listened. The lesson of every ignored warning in history: build a warning that cannot be ignored. The next generation of economists will use data science natively. They won't need to retrofit it. They will see the signals earlier and perhaps find ways to act on them in time. Trust in institutions erodes slowly and then all at once. Rebuilding it takes longer than the crash itself. The financial system that functions after a collapse must earn rather than assume the trust it squandered. Recovery is never uniform. It leaves a complex patchwork of progress and persistent pain. Those who entered the crash with the least exit it last. The models predict the macro recovery. The human recovery takes a generation. The official end of a crisis is rarely the actual end. It marks the end of emergency measures. The structural changes persist for decades. The data will know before the announcement is made. History judges decisions made with the data available at the time. This time the data was available, the models ran, the warnings circulated. What history will judge is not the crash. It is the choice to act or not to act. Multilateralism was stressed by the crash, not destroyed by it. Nations discovered that unilateral response was insufficient. The architecture of global economic cooperation must be rebuilt on the foundation of what was learned. Recovery is not the absence of damage. It is the presence of forward motion. The data model predicts the bottom. What humans do with the bottom, that is not in any model. The work doesn't end with the crash. The next model is already running. New signals, new patterns, new windows. The question the team asks every morning: what does the data say today? The models were built by people who believed data could protect, not replace policy, not substitute for action. But give the world enough time if the world chose to use it. That choice is still being made. Every cycle ends and begins again. The new system will also accumulate its own instabilities over the coming years. The model will eventually see them. The question is whether we will by then know how to listen. History is not what happened. History is what we choose to remember and what we choose to learn. The data is still there, every data point, every signal. The archive is open. The question is whether we read it. This is not a story with an ending. Economic systems do not end, they transform. Data science does not predict the future. It maps the probability landscape of the present. The models see the aggregate. They cannot see you. Your choices remain outside the reach of the machine, but you are in every percentage, every probability, every trend line. The work of prediction is the work of care. You run the model because the outcome matters, because real people live in the output, and somebody has to be paying attention. The modelers weren't heroes. They were just people looking for the truth. They were scientists doing science. The heroism, if any, was in publishing the result. In saying, the data shows this, you should know. The data is not fate. Prediction is not prophecy. It is a map of the storm before it breaks. The model shows you what the system is doing. What you do with that is still entirely up to you. The signal is in the noise. The model has run. The dataset of a generation is finally complete. The window is named. The time for observation has passed. Action begins. What you do next is not a data science question. It is a human one.